Market timing is the third myth. And market timing is any attempt to alter the mix of assets that you have based on a prediction of the future. Okay? And the myth is that money managers can do this with an ability that will add value over a long period of time. They can do this predictably and consistently and add value in up or down markets by predicting. This is Dalbar. Now, the previous slides that we talked about the performance of mutual funds, okay, of actual funds. How did the fund do? And we already explained that that isn't necessarily how the investor does, right? Because the investor has to own the fund from the beginning of the period to the end of the period to get that fund's return. And if you only owned it for half the period, you won't get the return of the fund for the whole period. It's what you own. Dalbar studies investors, and it studies the return that investors get based on their getting in and out of the market, based on their jumping from one fund to the next. And it gets the average of the investor's return compared to the market. And this is a pretty consistent number. The average equity fund investor in this country over a long period of time, 20, 30, 40 years, is in the 2 to 5% range when the market is consistently near 10. We call this the behavior gap. Someone's misbehaving. If the market's getting 9 and the average investor is documented to get 3 or 4, either you, the investor, are misbehaving or the investment manager is misbehaving. Someone, and probably both, right? Because the market has documented, the prices of stocks have documented an increase in this country over any 10 or 15 year period of return, or period, about a 9 or 10% rate, and most investors aren't getting it. And the reason why is that we market time and we track record invest, and because our mutual fund managers stock pick. And so if you look in your book, you can write these numbers in the blue section, and do this because it's helpful for you to go back later. If you were to invest $10,000 into the S&P 500, so just into an index of the 500 largest companies in the United States, and you'd have left it invested for 20 years, from 91 until the end of 2010, there were 5,040 trading days, you would have gotten 9.05% return, you'd have turned $10,000 into $55,000. So 10,000 invested equals 55,561. If you missed the best 5 days out of 5,000, so five days where the stock market had its best return on those 5 days, those top 5, you would have lost over 2% of your return. Your total return would be 6.84. And by losing 2%, you're down almost $20,000. Your 10,000 would only have risen to 37,535. That's 5 days out of 5,000. Now, practically, nobody can get that unlucky, right? That they sell out and buy in after and just miss the 5 best days. The point here is most of the return that you're going to get out of 5,000 trading days is going to be found on about 20 or 30 key days where the stock market really compiles quickly, right? And we know that there are about 7 positive days for every 3 negative days in the stock market, and that the positive days outweigh the negative ones. Over 100 years, this has been true. But you miss 5 of them, and you lose quite a bit of return. You miss 25 of them, and you basically got a flat market. 20 years, you turn 10,000 into 14. But frankly, this is about what people are getting. Over 20 years, they're barely doubling money. When in fact, you should be able to double money, including the lost decade. They call 2000 to 2009 the lost decade when the stock market didn't change during a 10-year period. It's not true. A diversified account doubled money during that period of time, but the average investor didn't. Missed 40 of the best days and you were negative 1.04%. You just took your 10 grand down to 8. So I'm trying real hard to depress you in the first half of this.
You're doing a good job.
Because everything we thought, I sit next to people on the plane and they say, what do you do? I'm a registered investment advisor. Well, you know what I like right now? I like Panera. That was the last one I sat next to a lady. She loves Panera. I said, oh, good. It's great bread. No, the stock. Sorry. Good luck. I don't know if Panera's up or down in the next little while. But they think I do something that I don't. The myth that you have about an investment manager or a stockbroker or a mutual fund manager is that they should know something about markets that I don't know. And the fact is, only new and unknowable information can change the future. We'll get to that. Tactical asset allocation is market timing in disguise. It's when you're not just deciding between stocks or fixed income, but you're deciding between small international versus value large companies versus fixed income versus emerging markets, Japan versus, I mean, you're trying to sector out the healthcare sector. And lots of people are getting older, I guess we need to go into healthcare. Well, when you try to predict the future, even in sectors, it kind of compounds the amount of negative that could accrue to you. It's bad enough when you're just trying to determine, is the stock market going to go up or is the stock market going to go down? That creates a lot of negative returns for folks and has been documented. It's compounded when they use the phrase tactical asset allocation. I get an email every day from the Financial Planning magazine, and it's always good for me to know what my counterparts are up to out there. But tactical asset allocation is a topic that's on just about one per week, one e-zine out of every week's 5 or 6 magazines that I get online, and we're going to help you determine what the next hot sector is, and it can't be done. So beware of tactical asset allocation. Charlie Ellis, I think I've got his book around here. He writes Winning the Loser's Game, and he writes a book on investment policy. He says the evidence with investment managers and their success with market timing is impressive and overwhelmingly negative. There is not an academic who has done the research in the last 50 years that will tell you market timing works, because there is no evidence of it whatsoever. And yet we think that my broker or my investment manager knows when to get in and when to get out. And most of the time how this plays out is not in them calling you proactively. Think about it. Have you ever been proactively called and said, I think the market's going down and I think you should get out? No. The market has come down a little, you're feeling nervous, you call them and they start talking to you about it. Well, if you feel like, so if you think about how the conversation gets started, it starts with your emotion. It compounds with the investment manager's emotion, which has a lot to do with whether or not you're going to pull your money. And the whole conversation goes down the road of, how do I keep your money? And if that means I have to move you out of the market to make you feel more comfortable, until you feel more comfortable, I'll move you back in. Investment managers are helping clients do amazingly bad things simply to keep the money under management, and nobody's tracking it. And it's a bad system.